They're moving something that most people treat as static. Not because its price changed, not because a headline screamed, because some places no longer feel like safe places to keep it. You expect gold to behave like a number on a screen. You expect it to rise and fall and be talked about in daily cycles. That is not the whole story. There is a quieter story that does not show up on a chart. What you own can be the same on paper and different in practice. A claim and the thing claimed can live in two separate worlds. And sometimes the world that holds the actual thing changes its mind. This film is not about price swings. It is about where the metal sits, about who chooses to hold it close, about what changes when custody matters more than markets. Most explanations begin with volatility, with yields, with charts. Those are easy to watch and easy to argue about. They are also a distraction. They keep attention on the spectacle and away from the quiet shift underneath. Imagine a process so slow it looks like routine. Trucks, warehouses, boxers, ledgers, no sirens, no emergency meetings in public. Yet the pattern matters more than most signals people follow. People say gold is an investment. People say it is a hedge. Those are roles assigned by markets and by habit. But for institutions with real leverage and political exposure, gold has always been a form of settlement, a thing to hold when paper systems become uncertain. This is not a dramatic accusation. It is an observation about behavior. Behavior changes before narratives catch up. Custody changes before commentators notice. Think about the small decisions that add up. An official prefers physical possession over a promise. A vault agreement is rewritten. A shipment is routed a different way. None of those moments make the front page, but together they alter a landscape. If you watch only the price, you miss the movement. If you watch only headlines, you miss the reason. If you watch only charts, you assume the answer is in numbers. This video asks a different question. What does it mean when the physical location of something people call a reserve stops being incidental? What does it mean when institutions begin to prefer local control? And what does that preference tell us about how systems are changing their definition of safety? We will move slowly. We will look for patterns in behavior, not sensation. We will follow small decisions rather than dramatic events. You may feel a mild discomfort as you watch. That is intentional. Not because we want an alarm, because discomfort is how attention shifts from an old frame to a new one, from seeing gold as a price to seeing it as a signal. This is not a story that ends in one act. It is not a single turning point. It is a set of choices, repeated and layered, until the landscape looks different to those who live in it. So begin by setting aside the chart, set aside the trading desks, and the daily headlines. Listen instead to the quieter vocabulary of custody, where something is held, who can access it, and under what legal and political roof it lives. We will not name every actor. We will not give a list of events. We want you to notice the shift before you know the particulars, because the shift often precedes the particulars. There is a reason this kind of movement matters. It is not measured by daily returns. It is measured by who can move and who cannot, by which vaults get cleared first and which accounts stay. Expect to learn how ordinary gestures, shipping choices, storage preferences, settlement demands add up to strategic repositioning. Expect to see how these small moves speak louder than market noise when a system is being quietly This section is the wake-up, not a call to panic, a call to look at a familiar thing differently, to consider custody as a language that institutions use to express confidence or the lack of it. If gold can move without price, then something else can move without headlines. That is the unease we begin with. It is quiet, it is intentional, and it will change what you look at next. This is not the first time something solid has drifted away from where people assumed it would always stay. Across different eras, systems show a similar habit. When confidence is broad, location feels irrelevant. When confidence narrows, location becomes everything. The pattern does not announce itself. It does not begin with collapse or crisis language. It begins with preference, with quiet reassessment. When a system is trusted, distance feels safe. Assets can live far away, under layers of abstraction, guarded by rules instead of proximity. People accept this because the system has earned that acceptance over time. But trust is not permanent. It stretches, then thins. And when it thins, behavior changes before belief does. Historically, value migrates before explanation follows. Not in a rush, not in panic, in measured steps that feel administrative, even boring. What matters is not the specific asset. It is the instinct behind the movement. The instinct to reduce dependency, to shorten the chain between ownership and access. In stable periods, custody is outsourced. In uncertain periods, custody is This is not a moral judgment on institutions or places. It is a mechanical pattern. When systems grow complex, they rely on trust. When trust becomes selective, complexity starts to reverse. Think about how people behave when they sense friction ahead. They simplify. They choose familiarity over efficiency. They trade reach for control. Large systems do the same thing. They do not announce it. They rarely explain it. They just begin to behave differently. The most important movements are often framed as logistics, storage decisions, settlement preferences, jurisdictional comfort. Those words sound technical, but the impulse is simple. Who can say no? Who can delay? Who can change the rules in the middle of the process? When that question enters the room, assets start to relocate, not because the old place is suddenly unsafe, but because the definition of safe has narrowed. This pattern appears again and again. Before trust breaks publicly, it tightens privately. Before systems fail loudly, they adjust quietly. People often misread this stage. They expect warnings, they expect signals that look like danger, but what actually shows up is restraint, less exposure, less distance, more direct control. By the time the public story changes, the movement has already happened. The asset is already elsewhere. The preference is already set. This is why watching price alone gives a false sense of calm. Price assumes continuity. Custody reflects doubt. In every era where systems reorganize, the same question returns. Where does value want to sit when trust becomes conditional? The answer is rarely where it has been advertised to sit. It moves toward places that feel closer, firmer, harder to interfere with. Not forever, just for now. That is the pattern. Not dramatic, not suddenly, but persistent. And once you recognize it, you stop asking when something will break. You start asking what is quietly being repositioned first, because systems do not change their stories until after they change their behavior. The first thing that changes is not the system itself. It is how people inside the system behave when no one is watching. Before rules change, preferences change. Before policies adjust, habits shift. And before trust is questioned publicly, it is narrowed privately. Systems rarely collapse from the outside in. They think from the inside out. At this stage, nothing looks broken. Markets still open. Contracts are still honored. Paper still clears. What changes is something more subtle. The tolerance for distance, the willingness to rely on intermediaries, the comfort with promises instead of possession. When confidence is high, convenience wins. Assets can live far away. Custody can be abstract. Ownership can be symbolic. But when confidence becomes selective, convenience loses its appeal. People begin to ask quieter questions. Not, is this allowed? But what happens if I need it now? This is where the mechanism begins. It starts with a preference for certainty over efficiency. A shorter chain, fewer signatures, less reliance on someone else's system working as expected. Nothing dramatic happens. No one announces a shift in doctrine. They simply choose the option with fewer assumptions attached. This is why physical things matter in moments like this. Not because they are superior, but because they remove layers of trust. A physical asset does not require a functioning network to exist. It does not need permission to remain what it is. It only needs to be where you can reach it. As systems grow complex, they become efficient. As they become efficient, they depend on trust. As trust narrows, complexity becomes a liability. So behavior adjusts. Institutions begin to favor arrangements that reduce dependency. They choose settlement over leverage, control over yield, clarity over optimization. This does not mean they expect collapse. It means they are managing uncertainty. And uncertainty does not demand panic. It demands optionality. The mechanism is simple when stripped of language. Hold what you cannot easily replace. Keep it where access is clear. Reduce exposure to rules you do not write. This is why these shifts are often invisible. They're framed as housekeeping, as risk management, as normal administrative decisions. But taken together, they signal something larger, a recalibration of what feels reliable. When enough actors make the same small adjustment, the system's shape begins to change. Quietly, gradually, without announcement. By the time commentators look for a reason, the behavior has already settled in. And once behavior changes, systems follow. People do not miss these signals because they are unintelligent. They miss them because the signals do not look like danger. The first blind spot is comfort. Stability feels familiar. Familiarity feels safe. And safe. Things are rarely questioned. When systems have worked for a long time, people internalize that success. They stop seeing it as conditional. It becomes the default setting of the world. So when small changes begin, they are interpreted as noise, as temporary adjustments, as technical details meant for specialists. This is how slow shifts hide in plain sight. The second blind spot is abstraction. Modern finance trained people to think in symbols, balances, statements, screens. When value lives on a screen, distance disappears. Location feels irrelevant. Custody feels like an old concern. So when physical considerations return, they feel outdated, almost primitive, as if something solid has no place in a sophisticated system. That assumption lasts right up until it doesn't. Institutions suffer from a different blind spot. They are not blind to change. They are constrained by narrative. Stability is part of their job. Not just operational stability, psychological stability. They manage expectations as much as assets. Admitting doubt too early can create the very stress they are trying to avoid. So signals are softened. Language is careful. Shifts are framed as routine. This is not deception. It is an incentive. Institutions are rewarded for continuity. They are punished for disruption. So they learn to move quietly. The third blind spot is comparison. People look for collapse to resemble past collapses. They expect panic. They expect obvious failure. When none of that appears, they assume nothing is wrong. But systems rarely repeat themselves in obvious ways. They rhyme, they adjust, they find new paths to the same outcome. This channel follows these patterns as they unfold. There is also psychological comfort in believing that someone else is watching closely. That expert will sound an alarm. Those warnings will come in clear language. But systems do not issue warnings. They reveal preferences. And preferences show up in behavior, not announcements. The final blind spot is time. Slow change feels harmless. If nothing breaks today, today feels safe. People extrapolate the present forward. They assume tomorrow will resemble yesterday because yesterday worked. This is why gradual shifts are so effective. They move below the threshold of urgency, below the level where attention sharpens. By the time attention arrives, the adjustment is already normal. The new behavior feels established. The old assumptions quietly expire. None of this requires malice. None of it requires conspiracy. It is how humans and institutions protect themselves from uncertainty. They normalize it. They minimize it. They look away until it demands to be looked at. And by then, the signal has already moved on. There is a moment when this stops being about systems and starts being about people. Not the public, the decision. Up to this point, it is easy to think in abstractions, markets, institutions, structures, but systems do not act on their own. People inside them do. And those people live in a different reality than the one most observers imagine. They are not reacting to headlines. They are not chasing trends. They are not thinking in terms of commentary or sentiment. They are thinking about access, about time, about what happens under stress, not on a normal day. This is where the angle changes. For most of the public, gold is an idea, a symbol, a topic that appears when inflation is discussed or uncertainty rises. For people responsible for reserves, settlement, and institutional survival, gold is not symbolic. It is procedural. It answers a very narrow question. If something goes wrong elsewhere, what still works without permission? This is why the movement we are discussing does not show up in dramatic moments. It happens during planning sessions, during routine reviews, doing quiet reassessments of exposure. The shift is not driven by fear. It is driven by responsibility. When you are accountable for continuity, you think differently. You do not ask whether a system will fail. You ask how it behaves under pressure. And under pressure, distance matters. Jurisdiction matters. Custody matters. This is also why the movement does not require consensus. It does not need everyone to agree. It only needs enough people to quietly decide the same thing. From the outside, it looks unremarkable. From the inside, it feels prudent. This is the moment where observers often get confused. They look for ideology, they look for confrontation, they look for declarations. What they miss is alignment without announcement. When enough decision makers reach the same conclusion independently, behavior changes without debate. This is not coordination. It is convergence. And convergence is powerful because it feels natural, unforced, almost invisible. Once you see it this way, the story shifts. It is no longer about east versus west. It is about proximity versus distance, control versus reliance. Gold happens to be the object moving, but the behavior would look familiar if it were something else. What you are watching is not a bet. It is a preference. And preferences, once established at this level, tend to persist quietly long after the noise moves on. This is why the story does not reverse with a price change, because the motivation was never price to begin with. It was something more basic and much harder to see if you are only watching the surface. The first thing that leaves is not metal. It is trust. Not all at once. Not dramatically. Just enough to change behavior. When trusting things, it does not announce its departure. It withdraws politely. It asks for fewer favors. It relies on fewer assumptions. This is how transfers begin. Not with movement everyone can see, but with decisions no one talks about. Capital follows trust, not headlines. It moves toward places where rules feel predictable, where access feels direct, where fewer explanations are required if something goes wrong. This transfer does not need urgency. It does not need panic. It happens while everything still appears functional. Legitimacy shifts the same way. Quietly, gradually, systems continue to operate, but belief in them becomes conditional. People still use them, but with limits, with backups, with alternatives kept nearby. Behavior changes before structure does. That is the rule. When enough actors behave differently, the system's center of gravity moves, not because anyone declared a change, because behavior stopped reinforcing the old one. This is why the movement feels slow. It is not an escape. It is a rebalancing. Gold is part of this, but it is not alone. It is simply easier to notice when something physical changes location. What is harder to see is what replaces what leaves. As trust relocates, so does confidence in the process. Local settlement begins to matter more than global reach. Control begins to matter more than optimization. These are not ideological choices. They are operational ones. When trust was abundant, distance was fine. When trust becomes selective, proximity becomes valuable. This is the quiet transfer, from abstraction to substance, from convenience to control, from assumption to access. Nothing breaks when this happens. That is why it is misunderstood. The system still works, just differently, and often not for the same people in the same way. Those who notice early do not announce it. They adjust. They simplify. They reduce exposure. By the time the shift is visible from the outside, the internal logic has already changed. Trust has already moved. And once trust moves, the rest follows. The danger most people watch for is the wrong one. They look for collapse, for a moment when everything breaks at once, for a clear signal that something has gone wrong. That moment is rare, and it is not where the real risk lives. The real threat is not loss in the obvious sense. It is a misinterpretation. People assume danger shows up as chaos, but systems usually change shape while appearing calm. What feels safe is often what is simply familiar. What feels stable is often what has not yet been tested. This is where perspective matters. If you think the risk is a crash, you watch prices. If you think the risk is inflation, you watch policy. If you think the risk is volatility, you watch markets. But if the risk is a change in how trust is assigned, none of those signals come first. The real danger is waking up inside a system that still functions, but no longer functions the way you assumed it did, where access is different, where priorities have shifted, where the rules are the same on paper, but applied more selectively. Gold moving is not the threat. It is the message. It tells you that some actors no longer rely on the same assumptions you do, that they are preparing for friction without calling it a crisis, that they are positioning for continuity, not growth. Most people misunderstand this because they expect intent, they expect confrontation, they expect a plan to be announced. What they miss is adaptation. Adaptation does not need agreement. It does not need explanation. It only needs enough people quietly deciding the same thing. This is why focusing on price misses the point. Price reflects sentiment. Behavior reflects belief, and belief changes slowly, then all at once. The threat is not that systems stop working. It is that they keep working, but in narrower ways. Ways that reward proximity, access, and alignment. If you do not notice the narrowing, you assume continuity, you assume fairness, you assume availability. By the time those assumptions fail, nothing dramatic will happen. No alarms, no sudden break. Just a realization that the system you relied on was already being used differently by those who understood it best. That is the risk most people never see coming. What matters isn't where gold ends up. It's what its movement makes visible. When something long treated as neutral begins to choose sides, it tells you that neutrality itself is changing. Systems rarely announce that change. They express it through preference, through quiet adjustments that feel technical until they don't. Gold is only one signal. It is not the loudest. It is just harder to ignore once you stop looking at price. If custody matters more than yield, if access matters more than efficiency, if proximity matters more than scale, then the system is already redefining what it trusts. And when trust is redefined, everything connected to it begins to reorganize. The question is not whether this movement continues. The question is what else has already started moving under the surface without needing permission or attention. Because history shows this clearly. By the time change feels obvious, it has been underway for a long time. This was one piece of that pattern. Not the conclusion, not the warning, just the part you can still see before the rest becomes normal.